Let's start off with the political environment on that end, because I was reading an equity research report yesterday highlighting that Kenyans voting in favor of the constitutional referendum in August has reshaped the political landscape, boosting investor confidence. Now we face this political wrangling that doesn't seem to be coming to any end. How are you reading the political temperature in the country right now?
Good morning, Alishia. I think the political wrangles we're having right now is actually a spanner in the works, because we had such a good run from mid last year. Once the constitution was passed in August last year, we had a good run. We had a bullish run, but now we see the index, even the stock market index, below its support of 4,300 points. And looking ahead, we have many hurdles. We also have the Hague issue. We still have suspects who are top officials in government awaiting the pretrial chamber to see whether they have a case or not. We also have an ongoing disagreement, which I believe is not insurmountable, but all the same, it has affected the market.
So what kind of risk factor are you starting to price in on the markets on a political basis here?
I would put it at red, if that's a high risk classification. I think we're still at a point where the political landscape really affects the markets, which shouldn't be the case.
Taking a look at what is offering some support, though, it's positive earnings that's been coming in. As I mentioned earlier, Barclays out with numbers, and I know that you haven't had a chance to look at it, but looking at that headline figure, pre-tax profit jumping 51% to 13.6 billion shillings, and of course being helped by that one-off sale of its custody business to a Standard Chartered. Your overall feeling around Barclays Bank right now?
Those are very good results. I think I expected something of that nature. 51% is good, considering in the third quarter we had it 6% up to about 7 billion. We look also at their core business. We look that they seem to move more into retail banking. They have reduced their non-performing loans by almost, I think, 10%. I think that figure is much higher in these results. We've also had them increase their assets in the third quarter by close to 10%. And I think all these things contribute to a very good stock. Also looking at the stocks at the bourse, I hear they have a split planned at 25%. This will improve liquidity and it might bring shareholder value in the short term.
Mm-hmm. Do you have a buy, sell or hold rating on the stock right now?
It's actually a strong buy, because obviously come split, a stock is always a buy recommendation, because once that happens, we expect the stock to grow afresh, and this should tip the scale toward more shareholder value in the short term. And also looking at the dividend payout, quite high at 4 shillings and 70 cents. I think that's something which most investors will be rushing for.
It's also splitting its shares to 4 for every one held, and that in a bid to improve liquidity on the counter. So we'll be monitoring activity on that front. Of course, as I touched on earlier, we've seen this business hive off its custody business as to Standard Chartered. With the benefit of hindsight and that cemented by today's numbers, what have you made of this restructuring at the bank to accommodate efficiencies from here on out? We've also seen the bank execute major layoffs at the company.
I think these are very good moves. I think the captain of the Barclays Bank is doing a good job at the forefront. I've not looked at today's results, but judging by the last third quarter results, we had them having concerns about salaries and staff-related costs. And this downsizing has actually done away with these costs, and I think laying off 200 managers may be a bit a pill to swallow, but I think it's a good move in the long run, and it should translate well for the bank.
Of course, in Standard Chartered's case, it raised 2.5 billion shillings through a rights issue to fund that acquisition of the Barclays unit. And if anything, I mean, these capital raising initiatives, like we saw with Standard Chartered, like we saw with KPLC, with KCB as well, demonstrating just how much liquidity there is in the Kenyan market right now. So how are you advising clients at this stage? Sit on the sidelines or buy on the dips?
I would rather buy right now. I think things will get better than worse. Looking at the commercial banks, looking at the increased net asset value ratios, looking at the increased debt insurance costs, which will bring returns later on in the year and maybe next year, I think it's the best time to get in and take positions. And we've actually seen this in the recent weeks, with especially with foreign activity. people taking positions on these major counters. We've had Equity Bank, who are also set to have a youth financing initiative. And we've seen a lot of appetite for these stocks. And as an investor, I would rather say buy right now.